I start today with you, as I feel almost compelled to do. After this disappointing jobs report, so many questions about the taper, questions about rates. Are stocks in a tenuous position today, Jim Lebenthal, or not?
Your Honor, I don't think so. And as evidence, I would submit to you, just take a look at our cyclicals. I mean, take a look. Obviously, you can take a look at energy. The stocks are going through the roof. But you can also take a look at financials. And this is pretty counterintuitive, the strong bid to them today, because after that jobs report, you might have said, well, whoa, maybe the Fed's going to back off a little bit. The 10-year yield, maybe it goes down. No, it went up. And it went up for one good reason. I can't explain the weakness in today's jobs report. I'm not going to explain it because it's aberrational to what we are clearly seeing in terms of the Delta surge has peaked several weeks ago. And you're starting to see the tentative green shoots from industries like the airlines that are starting to see demand pick up. We know that Delta hit them hard, and they're starting to see demand slowly pick up. Now, these are green shoots. They have a long way to go, but that's the reason why you're seeing the 10-year rate rise. Okay. That's why you're seeing the bid to financials. And I'm going to say one more thing, Scott. I'm sorry.
Go ahead.
You know, as tenuous, I understand we look at the headline S&P 500, and tenuous is a good word for it. But we are investors, and we look through that headline index number, and we look at the cyclicals that are setting all-time highs or at least 52-week highs, like Northrop Grumman, Industrial, Raytheon Technology, Aerospace, Marathon Petroleum, Refiner. Underneath the headlines, there is such a strong bid in the cyclicals. The evidence is there, Your Honor, that the cyclical reopening trade is on right now.
All right. Then why, Bryn Talkington, is Morgan Stanley's Mike Wilson now calling for fire and ice? Before, maybe it was fire or ice. 10%, maybe 20% correction. He says we've been calling for a mid-cycle correction to happen one of two ways. Fire, tightening financial conditions as the Fed signals tapering is coming. Ice, growth disappointment, particularly on the earnings side. He goes on to say today, and this is the bombshell, we think it's increasingly likely these scenarios happen together and we get a greater than 10% correction. Farmer Jim says everything is great. We're not in a tenuous position. Mike Wilson says, with all due respect, Farmer Jim, you've been baling hay for too long. I don't know what else you've been doing on the farm, but something's not right. Who's right? Who is right?
Well, I want to start with, as the wise Peter Lynch said, more money has been lost trying to predict corrections than has been lost in the corrections themselves. So let's start there. And I think that as we get later in the year, I mean, you know, Mike is obviously a very smart strategist. He's been calling for this correction for a really long time. And this could be another 2017, though, when peak to trough decline in the S&P was about 3.5%. And so, but then we got it in 2018. So I think his fire and ice analogy has legs, what he's saying. I do think, though, I do think that it's important to realize as an investor, you know, the Fed has been driving down the highway on cruise control at 90 miles an hour since March of last year.
Oh, I thought you were going to say forever. I thought you were going to finish like forever.
Right, well, kind of forever.